$30.39 on holding. The shoe brand behind the OnCloud beat earnings this morning, and the stock still fell as much as 22%, straight down to a 2-year low. What's up, guys? Coach B here. Welcome to the breakdown. Today it's on holding, ticker ONON, and this one's a clean lesson in why a beat doesn't always mean the stock goes up. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything here. Do your own research. Let's start with the chart. On holding closed Monday at $38.78. It opened today at $31.59, a hard gap down, popped intraday to a high of $31.75, then sold to a low of $30.11 and closed at $30.39. Close to close, that's down about 21.6%, with the intraday low printing an even uglier 22%. Volume normally runs a few million shares a day. Today it did about 35 million, roughly 10 times normal. Put that in dollars. 100 shares at Monday's close was worth $3,878. That same 100 shares at today's close, $3,039. That's $839 gone in one trading day on a stock that technically beat earnings. Here's the part that trips people up. On holding, second quarter earnings per share came in at 0.31 Swiss francs, ahead of the 0.29 analysts modeled, a real beat. But revenue, 850.3 million Swiss francs, missed the roughly 878 million the street expected, a shortfall of a bit over 3%. On top of that, management cut full-year sales growth guidance from at least 23% down into the low 20s. Beat the bottom line, missed the top line, cut the outlook, all in the same report, and that combination is why this one fell 22%. Quick gut check on why that matters. Earnings per share is what's left after you run the business. You can get there by growing revenue or by cutting costs. Revenue is the size of the actual growth engine, and a stock like On Holding trades on that engine getting bigger, fast. So when the engine itself misses and guidance says it's about to grow slower than promised, beating a per share number that can come from cost discipline doesn't fix the real problem. The market reprices the growth story, not the accounting, and the deceleration wasn't even across the board. It showed up hardest exactly where it hurts most. The Americas, more than half of total sales, grew about 13% in constant currency this quarter, down from around 17% in the first quarter. Wholesale, selling through other retailers, grew 12.7% constant currency, essentially cut in half from 25.1% last quarter. The bright spot, direct to consumer, on selling through its own stores and site, still grew 34.3% constant currency, the strongest channel in the report. This isn't a business falling apart. It's a business whose two biggest legs, the biggest region, and the wholesale channel both stepped down hard in the same quarter. Now let's pull up the options chain and see what the market's pricing from here. Shares have ticked back up a bit since the print, trading around $30.60 as this chain is priced. I'm looking at the September 11th expiration, 31 days out at the money strike 31. That call is bid 125, ask 166, call it $1.46 mid, implied volatility around 44%. The put is bid 136, ask 175, about $1.56 mid, implied volatility around 40%. Add those mids and you get a straddle worth about $3 against a $30.60 stock. So the market's pricing roughly a 10% move either direction over the next month. This is the textbook pattern with any earnings name. Going into a print, implied volatility runs hot because the options market has to price a real unknown, a binary event. Once that event happens and the uncertainty resolves, implied volatility usually drops hard, even if the stock keeps moving after. What you're looking at on this chain isn't pre-earnings fear anymore. The earnings are already out. It's the market pricing ordinary uncertainty about whether that low 20s guide actually holds. So how would I think about this by time frame? Day trading it, today's range, $30.11 to $31.75, is the whole battlefield. Swinging it, $30 is the new level everybody's watching, right under where that straddle centers. As an investor, the real question doesn't get answered today. It gets answered next quarter. Whether that low 20s guide holds or gets cut again, here's the honest downside case. If America's growth keeps stepping down and wholesale keeps sliding the way it did this quarter, that low 20s guide could turn out optimistic, not conservative, And a stock already at a 2-year low can still re-rate lower from here, even with direct to consumer carrying the business. Implied volatility is still sitting in the 40s, so that options market isn't calling a bottom. It's telling you it genuinely doesn't know yet. So that's on holding. An earnings per share beat, a revenue miss, a guidance cut, and a 22% crater all in the same session, because beating estimates only matters if the growth story behind the estimate is still intact. Same reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. Subscribe, and I'll break down the next name on the board, and drop your questions in the comments. Good luck in the markets, no matter what stock you're into.